Welcome to this deep dive. Today we are opening up a fresh stack of notes and research for a brand new Better Every Page on YouTube.
Yeah, and this one is really exciting. We're tackling a highly requested blueprint today.
Exactly. Our mission today is decoding how you can build lasting wealth without, living in a state of perpetual anxiety.
Right, which is huge.
It is. We're exploring the core mechanics and the psychological strategies found in Unshakeable. That's the Financial Freedom Playbook by Tony Robbins, co-authored with Peter Mallouk.
Yeah, and the central challenge we're tackling for you today is really just in an economic environment that feels completely chaotic, how do you actually protect your future?
Without obsessing over every single dip in the market, right?
Exactly.
Okay.
I mean, it is the defining financial question of our time.
Mhm.
And to really understand the weight of this book, we have to look at the psychological landscape it was born into.
Which is pretty bleak.
Very. It was published in 2017, so it arrived when the lingering trauma of the 2008 financial crisis was still dictating how millions of people handled their money.
Yeah, people had watched half their net worth just vaporize in a matter of months.
Right, and that breeds this deeply ingrained, visceral fear of the market. So Robbins steps into this arena, targeting two specific types of paralysis.
The fear of losing everything, and then just the sheer intimidation of all that Wall Street jargon, right?
Exactly. The goal is to strip away all that complexity and shift you from this defensive, reactive posture into a proactive, confident strategy.
Well, let's start dismantling that complexity right away because, we can't control the macroeconomic environment.
No, definitely not.
We can't control interest rates or global supply chains or any of that. But Robbins argues we can build an unsinkable ship.
I love that analogy.
Yeah, it's like trying to sail a ship while staring obsessively at the weather radar, just terrified of a storm.
Right.
We can't control the weather, but we can build a better ship.
Right. And before we get into the psychological armor you need to wear for that,
Yeah.
we have to understand the actual nuts and bolts of the hull.
So let's look at the foundational mechanics of wealth creation, starting with the engine itself.
The engine is compounding. Now, most people conceptually know what compound interest is, right?
Sure, yeah.
But Robbins emphasizes this mathematical inflection point that most of us just completely fail to appreciate.
Because we're wired to think linearly. Like, if I put in $10, I have $10.
Exactly. But compounding is exponential. The crucial phase isn't the beginning. It's the point at which the money your investments are generating completely eclipses the principal you are actively contributing.
Right. The longer that engine runs, the steeper the curve gets.
Exactly. However, that powerful engine is remarkably fragile if it encounters friction.
And by friction, we are talking about the wealth killers, which are fees and taxes.
Oh, absolutely.
Let's really break this down because the financial industry has done this brilliant job of making a 2% management fee sound completely harmless.
Right. They say, oh, it's just 2 pennies on the dollar. What's the big deal?
Exactly. But Robbins illustrates that over a 30-year timeline, that 2% doesn't just skim a little off the top, it devastates your compound growth.
The math is sobering, honestly. Let's visualize two people, right? Each investing $100,000 over 30 years.
Okay.
One pays a 1% annual fee, and the other pays 3%. Because that extra 2% is being extracted every single year, it is no longer in the account to compound and generate its own returns.
Right.
So over 3 decades, that seemingly tiny 2% difference can consume nearly half of your potential future nest egg.
Wait, half? Are you serious?
Literally half. You take all the risk, you provide all the capital, and the fund manager walks away with 50% of your lifetime returns.
Wow. It's like trying to carry water up a mountain in a leaky bucket.
That's a great way to look at it.
You might think a pinhole leak isn't a big deal compared to the gallons you're pouring in at the stream. But over a 5-mile hike, you aren't just losing the initial drips.
Right, you're losing the compounding volume of water that should have made it to the top.
Exactly. So to plug the hole, Robbins famously champions low-cost index funds over actively managed mutual funds. But let me push back on this for a second.
Yeah, go for it.
Active managers claim they charge that 2% because their expertise allows them to beat the market. Are we just supposed to accept that trying to beat the market is a fool's errand?
Well, the data strongly suggests it is. An active mutual fund employs highly paid analysts who are constantly buying and selling stocks, trying to outsmart the market.
Which costs money.
Exactly. All that trading generates massive overhead, tax liabilities, and high fees. An index fund, conversely, simply buys a tiny piece of every company in a specific index like the S&P 500, and just holds it.
So it's mostly automated.
Completely automated. It requires almost zero overhead, which is why the fees are often a fraction of a percent. And statistically, over a 15-year period, upwards of 90% of actively managed funds fail to beat their benchmark index.
90%.
Yeah. You're essentially paying a massive premium for underperformance.
Okay, so we plug the leaky bucket by eliminating high fees. That naturally leads us to the broader structural framework Robbins lays out, which he calls the core 4 pillars of successful investing.
Right. The core 4.
The first one is risk minimization. But wait, the conventional wisdom on Wall Street is that if you want massive returns, you have to take on massive risk.
And Robbins argues the exact opposite through this concept of asymmetric risk and reward. That conventional wisdom is exactly what gets amateur investors into trouble.
Because they just swing for the fences.
Right. The greatest investors in the world do not like risk. They are obsessed with protecting their downside.
So what does asymmetric risk actually mean in practice?
It means structuring your investments so that the potential upside vastly outweighs the potential downside. For example, he talks about the legendary investor Paul Tudor Jones, who operates on a 5-to-1 rule.
Okay, what is that?
He only risks $1 to make 5. Mathematically, that means he can be wrong on 4 out of 5 investments, and as long as that 5th one hits, he still breaks even.
Oh, wow. So he's building a cushion.
Exactly. He never puts himself in a position where a bad call wipes out his baseline capital.
Because the math of losing is entirely unforgiving. I mean, if your portfolio drops by 50%, a 50% gain doesn't get you back to where you started.
Not at all. A 50% gain on the remaining half only gets you to 75% of your original total. You need a full 100% return just to break even.
Right. The hole just gets exponentially harder to climb out of.
Exactly. And this ties directly into the second pillar, which is tax efficiency. We already touched on the third, which is low fees.
So for the tax pillar, it's about understanding that your gross return is basically an illusion, right?
Yes. The only number that matters is the net, what you actually get to keep after the government takes its share.
Which means utilizing tax-advantaged vehicles like 401ks, IRAs.
And holding assets long enough to qualify for long-term capital gains rates rather than short-term income tax rates. That mathematically preserves the compounding engine.
Makes sense. And the fourth pillar is diversification. But not just the illusion of diversification where you own, 50 different tech stocks.
Right, because if the tech sector crashes, they all go down together. That's not real diversification.
So what does real diversification look like?
True diversification crosses asset classes. You hold domestic equities, international equities, bonds, real estate, commodities.
Oh, okay.
And you also diversify across time by dollar cost averaging.
Which is investing a set amount every month regardless of what the market is doing.
Exactly. This mathematically smooths out the volatility because you buy more shares when prices are low and fewer when they are high. If one asset class is suffering a brutal winter, another is likely experiencing spring.
Which brings us to, honestly, the most fascinating pivot in the entire Robbins framework.
The psychology.
Yes. We have the mechanical blueprints, we know how to plug the fees, manage the taxes, and diversify the assets. But none of that matters if you panic. He spends a significant amount of time trying to normalize the economic downturn. The core argument is that market corrections are just a natural feature of the system, not a flaw.
Right. If we look at the historical data he presents, a market correction, which is defined as a drop of 10% or more, happens on average about once a year.
Every single year.
Basically, yeah. And a full bear market, which is a drop of 20% or more, occurs roughly every 3 to 5 years. It is as predictable as the changing of the seasons.
Yet every time it happens, the financial media treats it like this unprecedented apocalypse.
Every single time.
Here's where I struggle with this purely rational approach, though. We can sit here in a studio, look at a century-long chart of the S&P 500, and acknowledge that every single bear market in U.S. history has eventually been followed by a record-breaking bull market.
True.
But human beings are not spreadsheets.
No, we are not.
When you log into your retirement account and see that the money you spent 20 years saving for your kids' college has vanished by 30% in a month, your amygdala takes over.
It's an evolutionary survival response.
Exactly. So how does a normal person actually override millions of years of biological hardwiring to flee from danger?
Well, you don't override it in the heat of the moment. That is the trap most people fall into. Robbins argues that you have to preempt the panic by building what he calls your financial fortress long before the storm arrives.
Oh, okay, so preparation.
Right. If you wait until the market is crashing to figure out your risk tolerance, you have already lost. This is where the book fundamentally transitions from a math textbook to a manual on human psychology.
Because the entire premise rests on accepting the certainty of uncertainty.
Exactly. By accepting that the crash is guaranteed to happen eventually, you remove the element of surprise. And surprise is what triggers the panic.
That makes so much sense. When you remove surprise, a 20% drop stops looking like a catastrophe and starts looking like a predictable, cyclical event.
You basically reframe the winter season. Because think about it, what happens during a market winter? Quality assets go on sale. As the saying goes, the stock market is the only industry where the primary merchandise goes on a massive 30% discount. And instead of lining up to buy, the customers run screaming out of the store.
It's profound when you view it through that lens. And if we contrast this approach with classic financial literature, the difference is just striking.
Oh, totally.
Take Benjamin Graham's The Intelligent Investor. It is the undisputed Bible of value investing, but it is incredibly dense. It teaches you how to tear apart a corporate balance sheet to find intrinsic value.
Which is great, but Robbins takes a totally different path. He essentially admits that teaching you advanced quantitative analysis is entirely useless if he cannot first teach you how to master your own fear.
Graham gives you the formulas to value the stock, but Robbins gives you the psychological armor to hold on to it when the world is screaming at you to sell.
I love that. He uses financial literacy not just as a wealth-building tool, but as a mechanism for personal empowerment.
Because ignorance breeds reactivity, right?
Exactly. When you don't understand the machinery of the market, you are just at the mercy of the 24-hour news cycle. Education shifts you into a proactive state, making you unshakable.
And he takes this a step further by challenging our fundamental definition of the word wealth. He introduces this concept of real wealth, making a hard pivot to argue that a perfectly optimized 8-figure portfolio is a complete failure if it costs you your health, destroys your marriage, or leaves you miserable.
It is such a vital, holistic check. Wall Street measures success strictly by the internal rate of return, but Robbins forces the reader to zoom out and ask what the money is actually for.
Right.
If the pursuit of financial independence creates so much stress that you develop chronic illness or you alienate your children because you're constantly working to fund the explore portion of your portfolio, you are operating at a massive deficit.
Let's actually talk about that explore portion, because Robbins provides a very specific framework for translating these philosophies into a real-world portfolio.
The core and explore strategy.
Yes. Walk me through the mechanics of how this actually operates for a typical investor.
So the core is the impregnable fortress we've been discussing. This should be the vast majority of your capital, like 80 to 90%.
Remember?
It is built entirely on the core 4 principles we talked about. Diversified, low-cost index funds and bonds. It is meant to be boring, steady, and practically untouchable.
And then the rest.
Then you have the explore bucket. This is a strictly ring-fenced 5 to 10% of your capital reserved for high-risk, high-reward opportunities. This could be angel investing, individual tech stocks, emerging markets.
Okay, I have to play devil's advocate here.
Do it.
Isn't creating an explore bucket just giving people permission to treat 10% of their life savings like chips at a blackjack table? I mean, we know how tempting it is to chase the next shiny cryptocurrency or meme stock. How does this not just devolve into sanctioned gambling?
Well, it devolves into gambling if you abandon the rules of the core 4, which is why Robbins places strict guardrails on the explore bucket. It still must pass the test of asymmetric risk.
So you can't just throw money at whatever.
Right. You don't just throw money at a speculative startup because your neighbor said it's a sure thing. You conduct rigorous research, and you only allocate capital that, if it goes to absolute zero, will not breach the walls of your core fortress.
Wow, so the discipline required for the explore bucket is arguably higher than the core.
It has to be, precisely because the emotional temptation to chase massive yields is so strong.
That makes perfect sense. It's basically risk with a seatbelt.
Exactly.
Now, there is another highly practical, non-negotiable rule he establishes for navigating these waters, and it has to do with who you let steer the ship.
Ah, the fiduciary rule.
Yes.
Yeah.
He insists that if you hire a financial professional, they must be a registered fiduciary. Most people hear broker, wealth manager, and advisor and assume they all mean the exact same thing.
But legally, they operate in completely different universes.
The distinction is critical.
It really is. A standard broker operates under what the industry calls the suitability standard. This means they are legally allowed to sell you a mutual fund that is merely suitable for your age and income, even if there is an identical fund that costs half as much.
Wait, why would they do that?
because the more expensive fund pays the broker a hefty commission. They are legally permitted to consider their own financial gain when advising you.
Let's frame that with a real-world analogy for you listening. It's the equivalent of going to a doctor with a headache, and the doctor prescribes an expensive brand-name drug simply because the pharmaceutical company is paying for their golf trips.
Yep.
Meanwhile, there's a generic version sitting on the shelf that works better and costs $5, but the doctor doesn't even mention it.
That is exactly how the suitability standard functions. A fiduciary, by contrast, is bound by law to act solely in your best financial interest. They must put your wealth ahead of their compensation.
So no hidden kickbacks.
Right. If there is a cheaper, more efficient index fund available, they are legally obligated to recommend it, regardless of whether it pays them. If you do not verify that your advisor is a fiduciary, you are essentially leaving the front door of your financial fortress wide open to those hidden fees we discussed earlier.
So always ask, are you a fiduciary? And put it in writing.
Always.
That alone is worth the price of the book. But Robbins doesn't just want you to set up your accounts and walk away. He assigns active, daily practices to maintain this unshakable mindset.
Yeah, the daily work.
And one of the most surprising tools he recommends for managing a stock portfolio is actually a daily gratitude practice. On the surface, keeping a gratitude journal sounds entirely disconnected from maximizing tax efficiency.
It sounds disconnected until you look at the behavioral economics and the neurology behind it.
Okay, unpack that for us.
Scarcity and fear are the primary drivers of terrible financial decisions, selling at the bottom, hoarding cash during a period of high inflation, falling for get-rich-quick scams.
Right.
Neurologically, the human brain cannot process deep fear and profound gratitude at the exact same time. They utilize totally different neural pathways. By enforcing a daily habit of gratitude, you are actively conditioning your nervous system to operate from a baseline of abundance.
You are building the muscle memory to not panic when the alarm bells start ringing?
Exactly. When you operate from abundance, you have the emotional bandwidth to zoom out, look at the historical data of the market, and stick to your core 4 strategy.
Because if you are vibrating with financial anxiety, no amount of irrational data will stop you from hitting the sell button.
None at all.
As we synthesize all of this, the mechanics of compounding, the fiduciary armor, the core and explore frameworks, and the psychological conditioning, we really start to see the ultimate paradigm shift Robbins is offering.
Yeah, it's a huge shift.
It is the realization that building wealth doesn't require a crystal ball. You don't need to perfectly time the market tops and bottoms. You just need a mathematically sound strategy and the emotional discipline to not sabotage it.
Absolutely. However, to give a complete picture, we should probably address a common nuance in how this material is received.
Sure.
Robbins is a master communicator, right? And his superpower is distilling complex systems into digestible rules. But because his tone is so relentlessly optimistic and empowering, some might find the execution to be slightly oversimplified in practice.
I think that's a very fair warning. The global financial system is infinitely complex. No single framework can account for your highly specific tax situation or your family dynamics or an unprecedented geopolitical shock.
Exactly.
His optimism is a necessary catalyst to get people off the sidelines, but you still have to adapt the map to the actual terrain you are hiking. Unshakeable provides an incredible compass, but it is a starting line, not the finish line.
It empowers you to start the journey with your eyes open. And as we consider the end goal of this journey becoming truly unshakable, eliminating financial anxiety and building that impregnable fortress, I want to leave you with a different kind of question to ponder.
I love a good question to end on.
We spend so much energy trying to insulate ourselves from risk and discomfort. But if we completely remove all financial vulnerability from our lives, do we also risk extinguishing the hunger that drives us?
Wow. That is a fascinating angle.
Think about it. So many incredible innovations, bold career leaps, and profound life changes are born out of a little bit of financial friction.
Yeah, the necessity to hustle, to create, to solve a problem.
Exactly. If the ultimate goal is to be completely comfortable and insulated behind the walls of a financial fortress, we have to ask ourselves, does becoming unshakable inadvertently make us too static?
That's a great point.
Sometimes a manageable amount of uncertainty is the exact fire we need to build something extraordinary.
The fortress shouldn't become a prison of our own comfort. What an incredible concept to chew on. We have to secure our future without losing the drive that makes the present worthwhile. Well, thank you for joining us on this Better Every Page deep dive on YouTube. We hope this exploration of Unshakeable has given you both the mechanical blueprints and the psychological armor to navigate whatever economic weather comes your way. Keep questioning the consensus, keep building your knowledge, and keep growing.